Thank you everyone for attending this webinar. We'll start by introducing the Capital Pathways program. I will be moderating today's webinar. My name is Lena Castanos, and I will give a presentation of the Capital Pathways program. Then I will um, introduce our guest speaker, Kara Glashin, who will be talking about some financial basics as you scale your business or you start your business. So what is a Capital Pathways program? It is a program that's funded by the U.S. Treasury and the SSBCI initiative, and it is meant to help businesses access capital. It's a specialty program from the Virginia SBDC that helps businesses build the systems and habits that they need to become capital ready, more specifically. It offers a more immersive, hands-on approach, combining group experience with one-on-one support, and the focus is on financial and legal readiness. The eligibility for this program is for very small businesses with fewer than 10 employees or businesses that are um, finding it challenging to access traditional financing. So the business must be actively looking for capital, and it must be very small or show that they are struggling to access financing. The program consists of self-assessment and then 3 different tracks: the legal structure validation track, the financial skills and tools track, and the loan application readiness track. I can go into detail on the assessment itself. The program offers guided self-assessment that clients go through in the beginning when they request counseling from the program, and it pinpoints gaps from these businesses, and the advisor, the intake person assesses what your needs are and provides a tailored approach to what you need. And based on our program offerings. So if you don't meet our criteria, we can refer you to other sources like your local SBDC that can help you with your current needs. But if you do meet our criteria, we have several program offerings that can help you get the skills that you need to access capital. So one of our key pieces is our legal structure validation piece. We're partnering with a law firm that can help businesses with their business registrations, trademarks, and contracts and agreement reviews. And we have business advisors that can also help you with those legal aspects. Depending on the complexity, we put you in touch with a law firm or not, or help you in-house. Then there's also the financial piece, the financial track. And for that, we have, first of all, financial webinars like this one, which is small business financial basics. And then there's also another one that is led by Kara as well, and it's on financial statement preparation, which is key to your loan application. And that one will be offered, I believe, next month. So be on the lookout in our website for upcoming webinars. We'll also dedicate a few minutes to show you what upcoming webinars there are from our program. There's also QuickBooks training that will be offered once every 2 months or once a month, depending on the month. And we have actually our next QuickBooks training webinar this Thursday, and I encourage you all to attend if you have QuickBooks and you are interested in learning how to use the software. There's also our one-on-one support. It is really tailored to your business needs. It doesn't have to fully meet every single one of these categories. You might not need help with all of these categories, but it's meant to give you a boot camp offering that's individualized. It's tailored to your business specifically. And it starts with going over business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender prep. Our in-house business advisors help you with these, and then um, we, in the end, connect you with a lender that's one of our partners that can give you support in the final stages after completion of this individualized support. This piece is the piece related to the lender that we partner with. And with this partnership, we are going to offer webinars that go through what lenders look for in loan applications, a more interactive one that's going to offer mock loan interviews with different lenders in breakout rooms and sample application analysis in groups, and then another one by an SBA partner on SBA loan options. And that one is coming up, I believe, next week. We have an SBA loan options webinar led by an SBA staff member. So I encourage you, if you're thinking about capital, to attend that and know what your options are. Then there's also one-on-one advising that's provided by our partnership with our lenders, and that's also available to clients that go through our program. So if you are interested to sign up, it's support that's at no cost to you. And you can scan this QR code. You can go to our website, or you can reach me via email. The slides are going to be shared in the end of this presentation, so you can access this information after. And I will also be putting this information in the chat in case you want to save these links now for the future. And now we can go through what everyone has been waiting for, which is our presentation on organizing your finances. Just a little bit about myself. I have a background mainly in small business support and access to capital on an international basis, and economic development. And I am very excited to lead this program. I am both a program manager and one of the advisors, and I will turn it over to Kara to give it away for the rest of the presentation. Thank you, Kara. I'll let
Thank
you
you.
share the slides now. Oops. There.
You should have a request for me to share.
There.
All right. Good to go. Can you see my screen? Right where you left off?
Yes.
Okay, so let's get into it. Thank you so much for the introduction, Lena. As you said, I'm Kara Glass-Sheen, and I'm a business advisor with the Virginia Capital Region SBDC. So we're based out of Virginia, and I specialize in financial support for small businesses. But before joining the SBDC, I worked as a bookkeeper and a fractional CFO, mostly for startups, where I helped both of businesses dig out of financial messes and work to prevent them in the first place. So I'm happy to be here. And as Lena said, looking forward to be able to pass this information along through recording, through these slides, and let's get into it. So through a few times, I will be sharing anonymized stories of actual SBDC clients. And so I wanted to start with one of those. Let's start by meeting Sarah. So Sarah is a Richmond cleaning service business owner. And by most outward metrics, she is a very successful business owner. She's fully booked with customers. She has an excellent service reputation. But when we start to look into the finances, that's where we have some struggles. Come tax time, we've got a shoebox full of mixed receipts. It's a headache trying to get everything in line for those tax filings. She's unable to prove income for equipment loans. And she's afraid to hire in case things might slow down in the future. Overall, this leads to stress and overwhelm in the business. A lot of business owners I talk to through the SBDC look a lot like Sarah. So now let's talk about the core problem. I think really the core problem comes down to reactive versus proactive financial business management. Essentially, business owners are acting like firefighters when they should be acting like an architect. And this isn't how it has to be. But once you're in this position where you're fighting financial fires, you're scrambling at tax time, you're missing opportunities, and you're constantly stressed, it just becomes harder and harder to get yourself out of this position. So we want to move towards that proactive business management, which looks like preventing these problems, being prepared, seizing opportunities as they come, and confidently making your decisions. So this is the shift that we're trying to cover today. From this reactive financial chaos to proactive financial control. Ideally, these can be the same businesses, just different stress levels. So that firefighter, again, scrambling for information, making choices based off of your gut or what sounds right, and missing growth opportunities, to having the information at your fingertips, making these data-driven decisions, and being ready for growth and funding. These are today's learning objectives, which looks like a lot, so I'm going to try to take my time going through them, but we are covering a lot of information, so I encourage you to, if you're watching this on recording, rewind, go back, revisit what you need, and importantly, talk to a business advisor, business mentor with anything that seems to be a sticking point. So we'll start with how to separate those personal and business finances, really what that looks like and what some mistakes are to avoid. Then what basic bookkeeping looks like. So this is often thought of as QuickBooks, but there are some intermediate steps that can be built upon before we get there. Then what are some other types of systems to track revenue, expenses, and your receipts? Once we're doing all of that, you might have some financial reports. So we're going to start to get into some of these financial reports, but just at a basic level, because we do have that webinar that goes into this in much more depth next month. And this is where it really all comes together, the why it's important to do this. Once you have your clean separation, once you have some sort of a bookkeeping system, you're tracking things that relate to your business financials, you're looking at your reports, now we can use that to set some goals, to come up with plans, and to potentially forecast your future cash. Getting into some more examples, what are the costs of this reactive type of management to folks listening in? These could sound familiar. Dealing with a truck driver who lost the opportunity to get an equipment loan. business was good, but they couldn't prove income because they had such intermingled business and personal finances. There's a restaurant owner who didn't keep track of their financials over the course of the year and then have to shell out thousands of extra dollars to pay a CPA at tax time. Consultants that are missing legitimate deductions, whether that's business travel, business meals, home office expenses, things like that. These costs, they seem small at the time, but they add up. There's contractors who aren't making informed pricing decisions because they don't review their numbers and they're missing out on profit. And then the really painful ones, I've seen folks trying to go through selling their business, but because they haven't had a good history of record keeping, actually having to lower their sale price because potential buyers can't get the financing that they would want to purchase because of those poor financial records. It can't be approved by a bank. So what does this look like when things are being handled proactively? Well, we see a food truck get an $85,000 expansion loan in less than 3 months, open up a brick and mortar. You can see a contractor effectively raise their prices without losing customers. We can see consultants who work in seasonal businesses be able to build their cash reserves to weather slow times confidently. And we can see a photographer who was previously really struggling paying taxes at an annual basis, switching to quarterly and no longer having to worry about the massive April tax bill. So we are ready to get into learning objective number 1, which is the foundation of this proactive management, the separation of business and personal financials. Again, everything is going to be framed in this same back and forth, reactive versus proactive. So in this case, reactive financial separation is, I'll deal with this later. You've got mixed accounts everywhere. You've got business expenses on your credit card, your personal credit card. You have personal expenses on your business debit. What you end up doing is you put your personal liability at risk. You are creating credibility problems, and this just makes everything way more complicated at tax time. When we move towards that proactive separation, where you have clean separation from day one or from today, wherever we are in your business journey, you're going to have a more professional image. You're going to have better legal protection, and it's going to simplify compliance, leading to more growth opportunities. So again, why is this so important? I meet a lot of business owners who, they're sole proprietors. They own the LLC. They're like, well, it's my money anyway. Why shouldn't I just pay my electric bill through my LLC bank account? And the number one reason, if you talk to attorney types, it's that this can pierce the corporate veil. Basically, when you form an LLC, you're creating a barrier between you as an individual and your business entity. And when you start to mix personal and business funds, you're taking away that barrier. So if anything were to happen, your business were to be found liable of something, maybe they were sued, you would potentially be able to have your personal assets at risk if it's been shown that you are not practicing good separation. Secondly, is just that taxes are complicated. Both state and federal taxes and even local taxes often require clean records. And if these are a mess, it's just going to be a lot harder to give accurate information. And if you end up being audited, it is a whole additional mess of being able to prove what you reported. Of course, there's just the professional credibility. Banks and lenders, they will recognize serious business owners based off of this separation. And then we want to be able to make our decisions quickly and easily. And having this separation is going to eliminate a huge amount of the confusion. So step by step, how we should approach this is step 1, as early as possible, you should open up a dedicated business checking account, perhaps also a business savings, depending. There's a lot of different bank accounts you could use. It depends on your business, what your priorities are. Do you want to have a local branch where you can call someone, know a small business contact? If so, working with a small bank is a great option. Do you want a simple, fast solution? If so, there's some really good online banks that are built for startups. From there, it's making sure that we have good ways to spend our money. So at this step, you might consider getting a business credit card. This is great because it builds a separate business credit history. but it's also not required. If you have a business debit card and you're able to separate those financials, there might be reasons that a business owner wouldn't want to get a business credit card right away. Step 3 is to make sure you have a really clear business payment processing for your customers. So how will you receive cash from your customers? There's things like PayPal, Square, your bank may have specific offerings. It's okay to have simple systems like I only accept check payments, as long as that's clear and outlined and creates a way for customer cash to go directly into your bank account. Then for this one, I feel like is often overlooked or skipped by business owners trying to do everything right. And that's creating a system for paying yourself. Especially if you're early on, cash is tight, and you're a sole proprietor or a sole business owner. It might take some time for cash to stabilize, but even so, making those monthly owner draws makes a huge step, creating that practice, and can really show that you're serious and should you be going for loans or anything else in the future. And step 5 is if you previously had automatic payments or subscriptions set up under the wrong accounts, to just make sure, go through, do a scrub, get everything up to date. And by the way, if there are any questions coming up as we're going through material, the questions can be put in the Q&A. I will keep a half eye over them. Oh, awesome. Thank you, Adam. So with step 4, he's asked to provide an example of what creating a system looks like to pay yourself. We're going to go into that with a spreadsheet. It can be as simple as I'm going to pay myself on the 15th of every month. If you're using QuickBooks, you can do something similar, or the more formal option is to actually set yourself up on a salary, which does get a bit more complicated, but once you're ready, it's a good step, it's a good way to go. And there's no limit on how many draws you can do. I think what you want to be able to do something that is replicable over time. So I see people that like to pay themselves on the 15th and on the last day of the month, or the 1st and the 15th. Or you might have a base amount that you pay every 15th. And if there's extra profit in the business, you can pay yourself a little extra. Again, there's a lot of different systems that could work. But being able to show a good, clean system, and we'll get into this in a few slides, goes a long way to demonstrate credibility. Additionally, there are some separation mistakes that I see a lot, and they should be pretty clear. It's people using their personal accounts, and it starts off just like one at a time to pay for a business expense, but you've got your personal credit card hooked up to your Amazon, and then that one time turns into 5 and 10, and then it's just a regular thing. It becomes really easy to lose track. Second is paying those personal bills with business credit cards. One personal bill as the sole proprietor people forget about is technically your LLC is a pass-through entity, and your business taxes, these are not business taxes when you pay to the federal government. So these should be also treated as an owner's draw for tax transferred out of your account and then paid to the government, because again, it's coming from your personal returns in most cases. Taking out these random owner draws without documentation. This is still better than just using a business card for personal expenses and counting that as an owner draw. But really, as much as we can, we want to start getting ourselves to the point where our owner draw almost looks like a salary. And as a business matures and your revenue increases, your profit increases, switching to a salary often makes sense. Not for all businesses, but. And when it comes to, so this is some tips for tracking owner's draws. If you're just using a spreadsheet, it can be really simple. A quick memo, register, log, and your date, the amount, that's all you need. If you're using QuickBooks, we want to make sure it's categorized under the equity section. This is not a business expense. And we want to see that consistent timing. It can be weekly, it can be monthly. It's just going to look more professional. And again, if we're using QuickBooks, having that simple memo describing it. A lot of times if you're applying for small loans, they will ask for proof of owner payment history. And a log like this is all you need to send it to the lender and be like, look, here, pay myself regularly. This is what it looks like. And then finally, not tracking legitimate business reimbursements is a mistake. There are times, of course, where reimbursements are the way to go, where you need to use personal funds to pay for a business expense and then reimburse yourself. But we want to make sure we're doing that in a way that's really clean, easy to track, and maybe, based around travel or timing. So for the most part, for paying yourself, it's simplest for people to simply transfer that cash from your business bank account to your personal bank account on those dates. You don't, as long as you're just taking an owner's draw and you're not paying yourself through a salary, which again is a great thing to do when your business is ready and when you know you have the cash flow and you kind of hit some maturity points. So now, getting into what basic bookkeeping looks like. And this is going from some reactive chaos again to hopefully more closer towards proactive systems. But what I really want to emphasize is you don't have to overnight go from square one to 50, right? We can implement small changes over time, and that will get you on track without having to, basically build a whole accounting department overnight. Again, what does this reactive bookkeeping system look like? It looks like I'll worry about this at tax time. I will deal with it quarterly. I have those receipts over there in the corner. I'll pull them together and add them up when I need to. It's stressful. You're likely to have errors. You're going to miss opportunities. And you frequently may end up having to pay someone else to fix your mess. So in a proactive sense, you can track as you go, and then you know where you stand. You should have more confidence. You should be able to make better decisions. There should be more growth opportunities, and information at that point becomes your advantage. So I've built this out for what I see as typical levels of bookkeeping for small businesses. I should say that there are levels beyond level 5, but very few small businesses need to worry about that. So level 1, I'd say this is where a lot of folks who come to me start. They are running their business off of their bank balance, right? You need to make some purchase, check your bank account. Do I have the cash? Yes, no. And that's how you make your decision. I do not recommend this by any means, right? We want to move from this because it just represents a single point in time and not true trends of your business. So from there, I'll see some folks come and they've got what I call level 2 bookkeeping, which means maybe they have a notebook, maybe it's a simple spreadsheet, but they're keeping some sort of a loose track of revenue and expenses. They might be missing some stuff, but the intent is there. And then level 3, that's really our focus for today. This is where you're capturing a lot more of the detail, hopefully through a spreadsheet, Excel or Google Sheets, and you're keeping track of your expenses and your revenues by category. And for some businesses, this may be all you need. I recommend this if you have a really low number of transactions, you've got a simple business model, and you don't have a lot of accounts to keep up with. But for a lot of businesses, eventually you do graduate from this level. You may need to get a free or a basic accounting software. There are some options before you get to QuickBooks. For others, it makes sense to go straight to QuickBooks because you know you're going to want to take advantage of the payroll features, or you've got a growing team, you've got a lot more going on, a more complicated business model. And this, I need to plug, of course, the webinar coming up on Thursday. It's specifically focused on getting QuickBooks set up for your business. So like I said, basically level 3 to level 5, these are okay, depending on where you are in the business. What we want to do is we want to move on from level 1, level 2. If we're talking about spreadsheets, first cover what do we track, because I see some folks miss some of this information. They're tracking, but they're not capturing everything. And keep in mind too that you'll be paying your taxes on a cash basis, which means you pay based off of the date that cash is received. So it's not based off of when you send invoices or when you receive a bill. It's based off of when money is moving in and out of your account. So that's really what I want to be. When I say date, I mean the date that cash is received or is sent. For revenues, we want to be tracking the customer, their name, the business name. For expenses, we should be tracking the vendor. There's a lot of reasons to make sure we're tracking that vendor name, especially if we're that vendor is like a contractor or consultant, there's additional tax implications potentially. Of course, we want to be tracking the amount. We want to be tracking the category. I recommend to think about what types of revenue you have. If you have very different revenue streams, we might want to split those out. But again, if you have a simple business model, it's okay to just sort of track sales. And then the expense category, which we'll get into in a second. It's nice to have a little description. And then for customers, for revenue, track how did you receive that payment if you have multiple ways that customers could pay. For expenses, did you pay out of a different account, your savings, your checking, or even personal funds if you had to for reimbursement, or your credit card. Some common expense categories. These include cost of goods sold, which is also called COGS. Sometimes these are called cost of sales, costs, and these are these costs directly associated with the making or the production of your product or service. Not all businesses have cost of goods sold. If you're a really simple consulting business and you pay yourself through owner's draw, really the only cost associated with you doing business might be your time, but you pay yourself through owner's draw, so there would be nothing to report in COGS. If you're selling goods, then it's really important to track our COGS to make sure, like t-shirts, we want to make sure that we're pricing these appropriately and we're maintaining good profit margins at the unit level. Other expense categories include office supplies and equipment, marketing and advertising, travel and vehicle, professional services. These are like legal and accounting fees. Insurance, I recommend all business owners should get general liability at least. Utilities, and then owner's draws. Again, we're talking a lot about owner's draws, and I do recommend tracking these draws separately as they are technically a non-operating expense and they do not appear on your income statement. I'll get
Kara,
into, yes.
I have a question
Mhm.
from the chat. You mentioned tracking owner draws, but how would you track an investment? For example, I have extra money in my personal account that I want to invest in the business.
So that's some accounting platforms lump in owner's draw and owner investments because these are both like equity type dealings. Neither of them should go on the income statement because if you invest in your business, this is not revenue, it's not part of your operating. So in some accounting softwares, they combine it. I prefer to keep it separate to track owner's draws and owner's investments separately. And actually on the next slide, I can bring us to an example where I can show exactly how we would lay out the owner's draws and owner's expenses.
Thank you,
So
Kara.
we have, as part of this, I'm providing a sample template, which you can get to through these links when you access the PDF after this recording. But since there's interest, I'll just click into this one right here and should open up. Specifically, if we look at this is a one that I filled out. Actually, I'll need to fix this link. I thought this was the example one. This is the template, but we can still look at this one here. If we're looking at our statements here, we would be able to see any cash that we want to input, track separately any cash that the owner puts into the business, separately from any cash the owner takes out of the business. So I would track it maybe on the same sheet as an owner's draw, maybe on a separate sheet. But when you're starting your business early on, this is really important to track. If you're going for SWAM certification, they ask for proof of owner investment. So it's definitely smart to have a tidy version. But now let's get into this sample template. And I don't want to say that this is a perfect template by any means. It's one that I've worked with that's worked pretty well for me. You can make your own. You can find plenty online. You can look at this and be like, I'm going to be inspired and change it. There are no strict rules here, but I'm going to cover what is in this template that I really like, that I recommend utilizing for your business if you want to go this sort of simplified spreadsheet-based bookkeeping route. So starting with tracking revenue. Step one, as I mentioned, is to think about your revenue categories. This is going to be dependent on your business, and oftentimes simpler is better. So we don't want to create like, if you're selling retail goods, you don't want to be like t-shirt revenue, pants revenue, sweater revenue. That would just be too hectic. But you might want to track separately what you sell via Etsy versus what you sell at farmers markets. Or in the sample that I'm using, I'm thinking of my business as financial services. And I'd want to separately track my regular bookkeeping revenue from my hourly consulting revenue. So I would have those two expense categories. If I'm using the spreadsheet to track my revenue, this is roughly what I would want to show. I'd want to show the date that I received payment. This is a formula here that I use for creating the different tables. I'm listing the customer. I'm listing the amount that was paid. Again, I use a drop down for this category. I show the payment method that I received this cash by check. And the description is it's my regular January fee. So it should be, it can feel like a lot, but once you get into the habit, these are going to be categories that you're going to repeat and should get simpler with time. Into expense tracking, same sort of thing. We're laying out a spreadsheet. It's going to start with making sure that we're kind of going into it, defining these expense categories. And I'll get to that question in just a second, that with these expense categories, because we want them to be descriptive, so you as the business owner can look at them and be like, oh, right, this makes sense. I know what these expenses are, but not so specific that you have like an Adobe license category and a Canva license category. Again, we're trying to find the balance between detail and summary that can help you understand your costs over time. And so here I've received a question around using credit cards to pay for all business expenses. That way you can pull your credit card statement at the end of the year for tax purposes. You absolutely can use your business credit card as long as you are also paying off that business credit card regularly. And you absolutely can use your bank statements to compile for tax purposes. I would still recommend using a sheet like this and using this payment account and tracking month over month. What are you spending? What are you using your credit card to spend? Because this is where we're going to get that good data that's going to help us make information so we can make decisions monthly, quarterly, and not just be ready to cover taxes. Yes, that strategy absolutely works. To pay your taxes, you pull your credit card statements. Again, we can do a little bit better if we're trying to really look at business spend month over month. And I've seen folks make mistakes when they use credit cards because they don't feel the immediate spend of that cash because there's the delay between when you charge your card versus when you pay off your card. And also this is, I'd say, a little bit tricky part of using the sheet. I definitely recommend working with an advisor if you're using credit card payments to make sure we understand how this is affecting our cash flow. Now, with this, the same point here is you can see in this example, I put a business expense that I'm tracking as a personal fund. In this example, it might be because this was the first expense that occurred for my business. I was getting my Virginia SBDC LLC registration. And really, if you have to be using personal funds, we want to make sure we're keeping really good track. Ideally, when you pay yourself back from your business account, there's really two ways you could handle it. You could increase your owner draw, but I would want to add that as a note to my owner draw and say standard $500 owner draw plus $222 for expense reimbursements that are tracked here. So as long as we can follow that thread, you're probably in good shape. And I see additional questions coming. I'm going to keep storming through. Lena, if you can help manage the questions, if there's anything that I should address immediately, let me know.
Yes, of course.
So now this spreadsheet, again, it's not going to work for all of our businesses. it's a good starting point for brand new businesses. But this is why tools like QuickBooks are so valuable if things start to get a little bit more complicated. If we are using this simpler spreadsheet, I did want to share a little bit of information to understand what formulas and functions are being used. Should you want to recreate it? Should you want to follow it? For the most part, the formulas in these sorts of workbooks are pretty simple. Talking about like sum, which is adding up values over a column. This is more efficient than saying like cell plus cell plus cell. The most complicated formula I think I use in this sheet is a sum ifs formula, which adds up numbers based off of certain conditions. And I use that to take revenues and expenses from those input tabs to cluster them into the category and the month. So if you're up for a challenge, it's worth looking into trying to figure out that formula. If not, there's ways to go about it without using some of the more complicated Excel formulas. So this is also showing a summary table from that document with our total revenue for the month of January. Again, this business, 0 COGS, so nothing there. Gross profit is just the revenue minus the cost of goods sold. So here it's 500. Our total operating expenses are added up. And that's going to get us to our net income by taking our gross profit minus our operating expenses and then getting to that net income number. It's also useful to track cash here. So if this business started with 0 in cash, I have this sort of challenge question. If that net income was 331 and the ending cash was only 181, change of cash was only 181, what happened to that other bit of cash there, about $150? Let me give a moment. So I see in the answer, if we go back, it actually came from 2 places on this spreadsheet. This $100 that came from personal funds, this would be counted as an owner investment. So, and this $250 is counted as an owner draw. So there's an additional $150 combined by these 2 amounts right here that were subtracted from our net income. So really we had 500 in, 169 out, and then 100 in as an owner investment, another 250 out that got us to the 181 at the end. And so in this example, that owner investment, this is not counted as a revenue. That is simply counted as like an equity section change in cash, not due to operations. Because imagine if owner investments were counted as revenue and you had a really rich person starting a business and they put $1 million in their bank account just to get things going. It wouldn't make sense for that business to be taxed off of $1 million in revenue if truly they didn't do anything. They didn't sell anything to any customers. They didn't make any products. That was just startup capital. With now getting into, no matter how you're tracking your books, this is a step I see a lot of people miss, and it's monthly reconciliation. This is critical because this is how we're checking that everything we've tracked is accurate. This should be done on a monthly basis, and it can be done with a simple Excel spreadsheet like the one I've shown. It's also done on QuickBooks. So just because you're using QuickBooks doesn't mean you get to skip this step. Typically, the way we reconcile our accounts, it means we're checking our bank accounts and potentially our credit card accounts. You can reconcile others, but we're going to talk about these 2 ones. And you're going to check that you've captured every single transaction. And then you're going to check, if you're using QuickBooks, that the bank balance that QuickBooks thinks it is and the bank balance that your banks has are equal to each other. And I know this is where it starts to get a little complicated, but super important part when people fail to do this is when their bookkeeping gets off the rails. It's a good opportunity because if you find these mistakes on a monthly basis, it's a lot easier to fix them when you're just looking back to 1 month earlier than if you're looking back to like last year. So you should go through this process, find and fix any differences immediately. And again, if you're tracking that cash flow, you should be able to know you're correct, because the end cash in your bank account should be equal to what the starting cash in your bank account was that month, plus any cash in due to operations or non-operations like owner's investments, minus any cash out like expenses or owner draws or other things. Um, and then some of these common differences that people miss are sometimes there's some bank fees that you might not record because you forget about them. They just come and go out of your account. You might have like interest income that you might have missed. So then you're off by, a couple cents. Sometimes it's just timing that, you might look on your app on your bank. It might show it takes some time for certain transactions to fully clear. So maybe it hasn't affected your bank balance yet. So that's not a big deal. It's just like, oh, the timing's just a little bit off. And then there could be some automatic payments that you missed that you just forgot to record because it's just coming out of your account every month. Or you could be mismatching transactions across different accounts. Like you might accidentally double count moving money from your savings to your checking. These are the biggest issues I see that cause problems month to month. But at first, it's going to feel really overwhelming, but the more you do it, you'll know what to look out for. You'll get better at it. It'll feel a lot easier. And this matters, of course, because clean data is what leads us to more reliable reports, more confident decisions. Now, this is part one. I'm going to show this slide a few more times, but we're updating what are some time-saving systems that might not feel like they're time-saving when you're starting out, but things you can be doing as a business owner to make sure that you are on top of your finances. And this is weekly. You should be updating your revenue or your expense tracking. Just pick a time. If this is all you're doing, it takes less than 15 minutes. Stick to it. Log it if you're using QuickBooks. Again, Jamie will talk more about that in future sessions, but it's categorizing. It can be done really fast, especially if you're doing it weekly. Monthly, we want to be reconciling your bank statements or your credit card statements, double checking we're not missing anything. And then quarterly, looking at the bigger picture, taking a step back, are there new revenue categories? Are there new expense categories? And by doing this at this weekly, monthly, quarterly cadence, it's going to be a lot more efficient than if you're just doing it all at once a year. So we're on to learning objective number 3. These are a little bit faster. That was the meatiest one, the bookkeeping one. So we're going to speed along. Now,
Kara, before we move on,
yes.
maybe we could go through this question. Do you need to track any kind of information related to foreign domestic expenses revenue? In other words, is there any additional information you need to pay attention to when there is international commerce involved?
So this can get complicated. Most of the time, to make it simpler, what I would be watching is because really we want to be tracking. You pay your taxes in one currency, so foreign exchange can impact things quite a bit depending on the countries you're working with and the exchange rates you're dealing with. So I'd say this is a more advanced accounting topic, but businesses that do frequently spend or receive money abroad will have like a additional non-operating expense of gains or losses due to currency exchange. So again, to keep it simpler on yourself, trying to stay in one currency is helpful. But if you want to be more professional about it, tracking that exchange gain or loss.
And you can have negotiate with your bank an exchange rate every month, and just keep that exchange rate set and fixed every month with your bank. And this way, you don't have you would have to worry about exchange rate fluctuations month to month, but at least not every transaction that comes in would be a different exchange rate, if that makes sense.
Yeah, and Lena's got great experience working with these international markets, so definitely lean on her. So now we're just getting into some simple tools to track revenue, expenses, and receipts. Not as much depth, but sometimes your accounting system by itself doesn't cover everything you really need to get the full picture. So it's really has a lot to do with your business, making sure you're choosing the right tools. So when it comes to revenue tracking in particular, I think a retail business is going to have really different needs than a consultant. So in retail, there's some common ones that you'll see a lot. Etsy, Shopify, Square, all of these will have their own dashboards, their own reporting systems that you can look at, and they might give you a lot more detailed information that's provided at the ready than you might get from your accounting. For restaurants or food, there's Toast, there's Square for restaurants, there's Clover. Again, these are going to have more industry specific information. Like they might report back on like average customer check size, or excuse me, different like membership numbers if you're a gym. And this is going to be helpful again in terms of planning to really understand what's going on in your business. So if you're using any of these tools, using them is great, but actually using them to make decisions in your business is really how you excel. Again, and I'd say another great source if you're in this particular industry is to talk to other business owners in that industry and find out what they use, what tools they like. Going to networking events, working with your chamber of commerces, these are all great places because you're a business advisor. We have a broad overlook of a lot of businesses, but maybe not the specific tools that are going to work perfectly for your niche. And another note, some businesses you might only need a basic accounting tool. Others, you're going to need things that handle like payment platforms, like scheduling, inventory. So again, while I've seen folks when I've asked them, oh, do you use an accounting platform? And they say, yes, I use Square. But Square only covers half of the equation. It only covers their revenue, not the expenses. And most of these payment platforms don't do full accounting, but they can integrate with your accounting systems. So that's another great reason to get on QuickBooks, is if you have some really good revenue tracking tools that integrate directly. Now, getting into some of these, so some of the receipt tracking, I get a lot of questions about, do I need to be saving receipts? And the official answer is you should. You should absolutely be saving your business receipts. If you're working as an employee and you've ever had a business credit card, you know what a hassle it is. They want every single detail. They want pictures of the receipt. They want it submitted to their platform. You as a business owner should take that same level of care. So again, I recommend keeping track of these receipts in order to make it easier. You want to capture it immediately. So taking a picture right away, or using some apps like Genius Scan is one to automatically save and store receipts. There's also some more organized options, like if you have QuickBooks Online, QuickBooks Mobile, you can have the app and you can automatically link the receipt to transactions. And then there's even more advanced apps that auto-categorize and integrate with accounting systems. But we want to make sure also that as you're capturing these receipts that you don't forget what it was for. Sometimes a receipt doesn't have a detailed breakdown of what you spent it on. So you want to make a quick note. This was what it was for. This is who it was with. This is what I was doing. And again, the goal is to show the business purpose. So if you were to get audited, that's the whole point. You want to audit proof your business. You would be able to quickly prove, yes, this was a legitimate expense, a legitimate deduction. And I do not know about Clover QuickBooks integration, so I'd have to look into that for you. Now, special tracking systems. These are, I want a quick overview that sometimes your accounting system, your payment platform doesn't cover all the things you might need to track for your particular business. And I'm going to pause on that receipt question, that if you're forwarding receipts to be automatically categorized, do you also need to be saving the receipts with notes as well? And I'd say probably not, right? It's never hurts to have a backup, but we want to make sure we're doing at least one of these. And sometimes, things can get missed. So part of this review process might be going through on that monthly basis and checking to make sure that all of those things that you sent to QuickBooks were actually sent, or then you can go through and delete the things you didn't need. But redundancy is never a bad thing. So special tracking situations. First, if you travel a lot for business, I wanted to touch quickly on mileage versus vehicle expense tracking. Mileage for most, tracking mileage is going to be the preference for most small micro businesses. It's simpler. You're going to get more deductions than if you just track fuel, for example. And the way, if you're actually using your personal car for business, the right way to do it, which just sounds like a headache to me, is to track all of your personal car expenses and then to track all of the percent, like the month by month percentage time that you use your personal car for business with some sort of a log to demonstrate that. And then to basically figure out that cost percentage. So I recommend tracking mileage, like I said, but you cannot track both mileage and the actual expenses. There's some good apps out there, a paper logbook, a spreadsheet. These are all great. If you're a cash-based business, it's useful to have a cash log. There's some other things to track, like home offices. If you're using any other major personal equipment, you might want to track. Those separately, and then potentially client reimbursements. These are things that you might purchase on behalf of a client and have to reimburse back. These should be tracked separately because this isn't true income. If a client gives you $500 to register for a thing and you register for that thing, it's kind of going to go in and out. So let's see, I'm seeing a question here. I'm going to cover this and then I'll come back to the question on this section. So we've got this same time-saving systems that you saw before, but with a couple amendments. Now, in addition to weekly updating revenue expenses, if you're using these revenue tracking tools, we want to look into those. We want to log in, see if there's any trends. We want to check that our receipts are up to date and that, we can potentially delete duplicates if we're using QuickBooks or what have you. And then we want to update any specialized trackers and make sure that we've got those in good working order. So the question I have is, we have many products at different prices depending on the client and whether they pay out of pocket or a third party pays directly. We invoice weekly, monthly, and quarterly. We're having trouble finding the best software. So yes, that sounds like a complicated system. And I'd have to think about that probably with some detail because it's not just SKUs, it's discounts and payment systems. I feel like that would be a whole conversation with an advisor, and I'd probably have to do some research. But I'd say it's hard to find a system that works perfectly for specific business situations like that. And sometimes the answer might be to try to simplify things if possible, so we're not we don't need something so customized. But there are customizable tools out there too, depending on whether or not it's worth the cost is another conversation. So, and I think I did address that question. I don't know if Clover integrates with QuickBooks or not, but that would be a quick Google. So, what reports like income statements can show you? So we're on to learning objective number 4. And basically, again, we're not going to go into major depth on our income statement, our other statements today, because we're going to go into greater depth in about a month. But basically how I want to frame this is that your financial statements are like your business, or part of your business dashboard, right? Your car has gauges and your business needs them too. So like your car dashboard, it's going to tell you how fast you're going. Do you have enough fuel to make it to your destination? Is your engine overheating, right? Do you need wiper fluid? Whatever it is. Your business dashboard is going to be telling you, am I making or losing money? Your cash flow is going to be telling you, will I make it through slow season? Like that's that fuel gauge. And then business dashboard should also give you some indication of trends. Are you growing? Is it slowing? How's profitability? And really the key reports to monitor here are our income statement and our cash flow. I see my last question is what are the most common, they have to go back. Their last question is what is the most common way for content creators and freelancers to track expenses? Uh, I would have to, again, I'd have to do some search on specific for content creators. Freelancers, I know a lot of folks that like FreshBooks. Wave is popular amongst a lot of freelancers as well, and Wave does have a free uh, option, but there are some limitations. I'd say you can definitely reach out to an advisor and we can spend some time doing a little research on that. Sorry, again, when it gets into really specifics of what's the best tool for X business, it's hard to provide a definitive answer right off the cuff. So on to our income statement. I want to share this because your income statement, I find this a little confusing, that sometimes your income statement is also called your profit and loss, and sometimes people in a hurry will also call it your P&L. So income statement, profit loss, P&L, these are all interchangeable. But this is, for most people, the most important report for small businesses. And I know this is a bit small on your screen, so I apologize, but what is shown on your income statement is your revenue, which is all earned money coming in. Again, this does not include all unearned money at the top, which is like your owner investment. It doesn't include bank loans that you might receive. It's money from your customers, subtracting out all of your operating expenses, all of the money spent on your operations to get really to the core of this, which is your net income, what your business actually made from operations. It's telling us about your business's profitability. And I also want to say the note that you'll hear terms like net income, net profit, EBITDA. These are all slight variations on the same concept, and they can get confusing, but we will clarify these in that financial statements bootcamp. So when we're looking at our income statement across, it's best to look at it, in my opinion, in this monthly view. Looking at it as a snapshot of the year doesn't give us as much information about trends. So we want to see, is revenue growing? Is it flat? Is it declining? Do we have, this is just a summary, so we can't see the expense breakdown, but do we have certain expense categories that are growing really fast? Do we have changes in our profit margin over time if we're keeping track of our cost of goods sold? How does our month over month, how does it compare when we look across the year? Your cash flow is actually my favorite financial statement, but it is the reason why it's basically your fuel gauge, right? So with cash flow, you don't see that same operating level of detail, but you see all of the cash ins and outs of your entire business. So you'll see changing cash due to operations, but you'll also see more information that gets you to basically your starting cash, your end cash. So there's some reasons why we'll see a good business that looks profitable based on their income statement, or that's doing well otherwise, that they can still run out of cash. And that's because of some of these common cash flow challenges. I want to share these challenges and also what we can do about it. The first challenge I see a lot of is customer payment timing. And this is like you invoice a customer in March, you have to spend some money to deliver those services, and they may not pay till May. And so what to do about it, one, we can understand our payment timing. For example, the government contracting, we're going to have these sorts of payment lags, and there's not a whole lot we can do. Or we can recognize that we need to be doing more to get our customers to pay sooner. If you're a freelancer or a contractor, you might be spending a lot of time chasing down your customers and reminding them to pay the bills that you sent them. So there could be some systems that we could put in place to maybe automate that or encourage them to pay sooner. Next is owner draws. Again, these are, if you're taking your regular pay based on account balances, that's going to affect your cash as well. So we want to plan out our owner draws ahead of time, based on expected cash flow. So we know that if we're going into a slow season, maybe we don't take as big of an owner draw. So we're planning, and the business has the cash it needs to run. Credit cards can also make things a little bit more confusing because Monthly payments are due regardless of sales, so that's going to take that cash out of your account. And you might look at your bank account and say, oh, I've got plenty of cash to buy this big thing. You put it on your credit card, you forget about it. You look at your bank balance again, and you can easily end up overspending, over relying on credit cards or debt if you're not also monitoring those balances really closely. And then finally, there's going to be fixed expenses for most businesses like rents, insurance, loan payments. They're going to be due at regular intervals. And even those are going to stay steady even during slower times. So we want to make sure we're mapping out these fixed expenses and planning these cash reserves ahead. All right. So again, same slide you've seen twice now. Now it's time number 3. The only new piece here is we're adding to that monthly checklist that we also want to review these income statements and statement of cash flows, if available, on that monthly basis. And what we're going to be doing is we're going to be looking at trends, asking ourselves the questions that we reviewed on the other slides. Almost there, guys. Learning objective number 5. This is how to set goals and forecast cash flow. So this is from hoping to planning. We're now trying to steer our business a bit more proactively. A reactive approach here is that, man, I hope this year goes better than last. There's wishful thinking. You don't have concrete targets. You're not using clear goals on revenue or profits. And essentially, you're going to be flying blind. If you're proactive, you can set these specific targets for your business based off of real data. You can look at last year, see the trends, and come up with strategies to say, I want to increase my customers by X%, or I want to increase my revenue by X%. I want to add a new line of revenue that will do this. You can use evidence-based planning that have measurable milestones. And if you're doing this ahead of time and you're tracking how you're doing as you're going there, if you're not on the path to meet that goal, you can start to course correct before it's a total miss. So here's a bit of a framework for some types of proactive goals you could be setting. And how we could set them. So for revenue targets, we'd want to base that on historical data. If you're a brand new business, you can use industry data. You might be a restaurant. What is a good number of customers a day to get? What's an average customer spend on a meal? Do a little bit of math. For expense management, we want to make sure that we are setting goals that control these costs before they can take over and really hurt our profit. We might set goals around profit improvement, and that could just be small changes in pricing, maybe starting to charge for that add-on service that you've been giving away for free. Then we can set goals around having emergency funds. Like, we want to set a goal to have 3 to 6 months of extra operating expenses ready to go, or maybe to be used for a specific other goal, or the growth investment, which is to really have this information and to know exactly when you can afford to expand your business. Now, we can use the same spreadsheet that I shared to do some of this cash flow forecasting. This is more advanced, but I wanted to get into it a little bit. Again, that reactive cash flow management is, I will find more cash if I run out. I will find a grant. I will find a loan. We want to be proactive, and we want to be pretty comfortable that you will not run out of cash in the next 3 months, that you know roughly where your cash is going to sit in these 3-month intervals, which is a quarterly basis. So to forecast revenue, basically what we do is we would take what we know our income is going to be, what we know that revenue is going to be. If we have a certain number of customers, they pay us a certain amount. That is already signed up. We've got that. And then maybe we want to sell to one more customer. We can add in expected sales, but maybe we also know that there's a slight dip in March for some reason. So we're taking this, and we can use some formulas to set some goals on what our revenue will be monthly. And the goal isn't to get this perfect. It's the more times you do it, the closer you're going to get, the more accurate you're going to get with your business. It's a really good process to try to see. And if you miss your goal, to ask yourself the question, why did I miss? What happened? Did I lose customers that I thought were, sure things? Did I fail to sell enough? And then we want to forecast our change in cash by taking again that forecasted revenue and then subtracting out our expected operating expenses. If you've been tracking consistently over the past several months, you should have a pretty good idea of what you're going to spend. There's always surprise expenses, so you can add in a buffer. And then we want to subtract out any other non-operating expenses like owner's draw, loan payments, any necessary equipment purchases. But when we're just dealing in 3 months at a time, there shouldn't be too many huge surprises. And we should have a pretty clear pathway to that cash each quarter. Now, seasonality, this has various effects on a lot of different businesses. So in tourism, obviously, we can think about beach season, skiing, fall foliage, agriculture, very clear seasonal effects, construction, very like weather dependent scheduling, retail businesses, you've got Black Friday, you've got holiday seasons, back to school, professional services like bookkeeping, we might have to deal with tax season, year-end planning. So some businesses are going to have really obvious seasonality. Other businesses will have less obvious seasonality. And another type of seasonality I like to encourage people to think about for their business is your own work, your own. If you like to take a vacation with your family every year in September and your business can't generate revenue if you're on vacation, that factors into your business's seasonality as well. So once we have a good understanding of all of this, then we should be in a pretty good space to start making big decisions about how to grow our business. So with this framework, basically asking ourselves the questions, you should be able to say, do I have enough cash reserves to get me through the next 3 months? And if you don't, then what can we do operationally to build cash reserves? Do we need to sell more? Do we need to cut back on expenses? If we do, then we want to see, well, have we been consistently profitable? If we have not been, then let's look at see why we haven't been. Have our expenses been getting out of control? Has there been some changes in pricing? Maybe we have some customers that just take a lot more out of us than others, and we need to reevaluate that. If we're profitable, well, are we growing? And if we're not growing, what can we do to help our business grow? What are some low cost sales or marketing that can really boost our revenue month over month? If our revenue is growing, do we know, is our debt manageable? Are we paying off a lot of credit cards? Do we have business loans that are out that are hurting our cash? And if our debt is not manageable, then we need to spend some time before investing in growth to get to pay down or consolidate debt. But if our debt is manageable, then all right, let's go. It's a great time to set some big goals, maybe to think about hiring employees, purchase some big equipment, work on some marketing campaigns, maybe even plan a big location expansion. So this is where you can see big transformation in business. And if you've gone through all of these steps leading through this, then you can do so without feeling stressed out or wondering, is this going to totally tank where my business is today? So our action plan, this is basically summarizing everything we have gone through. No matter where you are, what are some things you can do this week or as needed? And what are some things you should be doing weekly, monthly, and quarterly? So if you do not currently have a business bank account, immediately after this, go out, get yourself a business bank account, start separating your financials. You can set up or update your appropriate tracking systems, whatever that might be. Maybe after this, you're like, I need to go onto QuickBooks, join Jamie's call on Thursday. That'll be a great intro. You can take some time to, at least today, start by gathering some receipts. You can start thinking about your calendar on when you're going to focus on these financial tasks to handle. I recommend blocking off 30 minutes to reoccur monthly and 15 minutes to reoccur weekly. And then, as needed, schedule a time with a business advisor or a mentor to help you stay on track. If any of these systems feel overwhelming or you know there's some area for improvement, business advisors are really great at helping people who know how they need to be helped. If you come in with specific questions, concerns, they're going to be able to strategize with you. And then what you see on the right, these are the same things you've seen slide after slide after slide, what we should be doing weekly and what we should be doing monthly, what we should be doing quarterly. So keeping your business's financials organized is not a marathon. It is, it's not a sprint. It is, we should be doing this at this regular intervals over time. We're not going to fix it overnight. And if we did fix it overnight, then we would just have more to do to keep up with it over time. So best thing you can do, even if you don't know where to start, is to just set aside the time, start doing something, getting a bit more organized, setting some goals. And again, a little bit often is much better than all at once. So before we wrap up, I've got to also go over those upcoming webinars. Highly recommend tuning in for additional. August 28th, this Thursday, is that QuickBooks 101. That's set up and start tracking your business finances. I've worked with a lot of business owners on cleaning up QuickBooks, and I can tell you 100% if it is set up properly at the beginning, you will save yourself so much frustration. If you're ready for loans, these SBA webinars, the loan-focused webinars, are going to be great just to get that high-level information. So then you can go to local banks and lenders with a much stronger application, work your way through the process much faster. September 17th, you've got me again on more in-depth on financial statements. And then October 15th, there's that QuickBooks 201. So lots of good stuff coming up. And I think I addressed a good amount of questions throughout our time, but if there's any additional questions, we can also come back to those now.
Feel free to put your questions in the Q&A. We'll wait a minute or two in case someone has a last-minute question.
That was a lot. That was a long time. I understand if people are tired. So otherwise, folks can reach out to advisors, and Lena, reach out to you personally. If there's questions that should come to me, you're welcome to forward them my way.
Certainly. And thank you so much, Kara, for that very helpful presentation. Again, oh, here, we have a question. Will the spreadsheet and this presentation be sent via email? Yes, the presentation will be sent with the slides, and Kara will send you this spreadsheet as well. Do you recommend getting a business credit card?
This is a tough topic because from the accounting side, for me, keeping track of your accounting becomes more complicated when you have a business credit card. Depending on you and your business, you might know because credit cards can snowball problems for businesses. However, if your financials are in good control, credit cards are great tools. They protect your cash if you're shopping online. It extends your cash flow because you have basically that month window from when you spend the money to when you pay off your card. There's a lot of really good starter credit cards out there. I'd say before applying for a card, make sure your credit is in good place. And because if you don't want to apply for a credit card, get denied, and then end up negatively impacting your credit. But business credit cards are great tools when used properly. So that is a non-answer, but provide some warnings.
What is the rule of thumb about paying my personal credit card via my business account? Should I do an owner's draw and then pay my credit card?
Anytime possible, you should always treat yourself like an employee. You are far better off taking your owner's draw, taking it in regular amounts, moving that owner's draw amount into your personal account, and then paying your personal credit card bill from your personal account. Um, that is what true separation looks like.
All right, let's wait maybe 2 more minutes in case
Yeah.
people.
And the links I put in the chat, the first one is an example where I have it fully filled out based off of a very simple business model. And the second link is the blank template. Sorry. Thank you, Sheila, for sharing that. Yeah. Otherwise, I hope people are feeling excited and not stressed. Um, and ready to go make some little tweaks. There's the thing with financials is there's always more that you can do. Fortunately, it's not something I think you're ever really done with. There's always systems that can be improved. Um, this is why you see huge companies with entire departments of folks focused on their accounting and finance. As a single business owner, you're taking it all on yourself, and we want to take on small, manageable pieces and kind of build step by step.
All right. Well, I don't see any more questions trickling in. If you have any more specific questions, we're available. We sent the website to make an appointment in the chat. There are also a few upcoming webinars that are coming up. I encourage you to check our website for those, and those who are registered to our newsletters. They should be there as well. And I would just like to thank everyone for attending, and especially Kara for giving such a wonderful presentation. And um, I hope everyone has a great rest of their days. All right.
Lena.
Thank you.